Hi everyone and welcome to my channel. Today we're breaking down JEPQ, which is the JPMorgan Nasdaq Equity Premium Income ETF. In this video, we will talk about what that fund actually does, how it generates income every single month, what companies it hold, how the covered call strategy works, the pro and cons, and whether it deserves a spot in your portfolio. So what's exactly is JEPQ? JEPQ is a Nasdaq income ETF created by JP Morgan. It's designed to give investors two things at the same time: exposure to large, stable tech companies. So all the big names, Nvidia, you name it, all those big, large stocks that we know are the leader of the market. They are the force that's driving the market. So you get exposure to those type of companies. Also, there is a high level of monthly income. Obviously, 10% distribution yield is quite high. And usually, like if you invest in tech companies like Nvidia or Google, most of them don't even pay dividend. And if they do, the dividend yield doesn't exceed 0.5% for those type of companies because simply they are growth companies. They are not there to pay dividends. Dividends are usually paid by stable companies. So what JAPQ does is allowing you to invest in those big tech and earn a distribution yield of 10%. So it does this by holding big NASDAQ stocks and then selling cover calls on them. But don't worry, you don't need to know everything about options to use this ETF. Everything is handled automatically by the fund manager. You simply receive the monthly distribution. This type of fund is built for beginners, retirees, income investors, or anyone who wants tech exposure with less volatility. So why this fund is so popular right now? Because it delivers four big advantages. First of all, reliable monthly income. As you know, the market, the stock market, one of the biggest growing trend in the stock market in the past 20 years have been the use of options. Options, think of them as a price for volatility and time. So basically, those options allow investors, especially through covered call, which is the most conservative option strategy that exists. And basically, those options allow now, right now, before it used to be just institutions using that, but now it's open to everybody. You yourself, you can buy Google and sell a covered call as long as you own 100 share. So what the manager of JEPQ does, he holds a portfolio of stocks and he will sell covered call on them to generate monthly cash flow. So that most of the income actually comes from premium earned when you're selling the covered call. And so that premium becomes the distribution that we as investors, when we buy JEPQ, we will get each month. The simplicity. So covered call can be complicated if you want to initiate it yourself. Though personally, I don't think it's that complicated, but it just you do the first one, the second one, and then you're absolutely fine. But if you would like a simplicity by investing in an ETF that does that for you, so the ETF does it even better than you because you're not going to be as diversified as the manager of JAPQ, which holds like hundreds of stocks where they can apply the strategy. Whereas for us as individual investors, just to sell one covered call, we need 100 shares. So imagine so you need a lot of money to own 100 share of each of the Magnificent Seven. So the JPQ does that work for us. You have also lower volatility because when you sell a covered call, you're basically forfeiting not any, but portion of the upside potential for the stock. So when you choose a strike, it's like you're forfeiting a portion of that. Anything above that strike, you're not going to benefit, and you get paid because of this choice. You get paid a premium, and this tends to lower volatility because imagine the stock could go lower or could go much higher or could go much lower because you're already setting and you know already the scenario you're going to be in the next month. You know, if the stock reaches this strike, I'm going to get this much. If it goes above, I'm going to have to sell my stock. If it stays lower, then I'm keeping the premium. So you have much lower volatility than someone who just hold the shares and doesn't know what's the upcoming month is going to be like. For a covered call, he knows already how his return is going to be almost a 50% idea of how the return is going to shape in the next month. So this makes for less volatility than just buying the shares. So what does JEPQ invest in? Let's look at what's inside this ETF. So it's basically invest in large established Nasdaq companies. The biggest names in tech, they are companies with strong long-term growth potential, steady earnings, and less volatility than smaller speculative tech stock. So with this fund, you're getting exposure to large cap. The goal is pretty simple here, give you exposure to leading tech companies, but with a smoother performance and monthly income on top. So this blend of income and tech is not something many ETFs offer, because one of the choices that you could have is invest in QQQ or similar, that just an index ETF that tracks the Nasdaq. You will not going to get any monthly income there. However, you will get 100% of the performance of the index. So that's one choice. You will face volatility. It's gonna go up and down. Whereas if you invest in JEPQ, you are in a sense investing in same thing, same exposure, large tech, but because of the option strategy, you're gaining a monthly income and you're having just a portion of the upside potential, because the strategy could limit the upside potential. So that's the big difference between an index ETF that tracks NASDAQ and JEPQ. If we look at the top positions in the fund, we find we have like Nvidia, Microsoft, Apple, Google. It's the highest position is 9% of the net assets, and you have a large, broad number of large tech companies there. So it's basically a blend of quality blue chip tech. So how covered call works? Let's quickly go through how JPQ generate that income. That's the simple version. So the ETF owns a basket of tech stocks. It sells call options on those stocks, uh, and it receives a premium. So those premium become your monthly distribution. It's very simple. So this is an example of out of the money. So why out of the money options will matter? It still allows some room for growth. The strike price is above the current market price, so the ETF can still gain before the upsides gets capped. Higher chance the option will expire worthless when you're selling out of the money. This is good because JPQ can keep the shares, keep the premium. This is the best outcome when you sell covered call, is to get to keep the shares, and also you keep your premium. So you can repeat this process on a monthly basis. Better balance between income and growth, as I explained. And so this is why JEPQ is often viewed as a hybrid ETF. It's not a pure income, not a pure growth. It sits right in the middle. But it's a more income, obviously, than growth. So real example with the covered call, for example, on Google. So Google was trading at 320 when I did the video. If the manager here sells an out of the money option with a strike of 325, and collects a $3, which is $300, because remember, it's 100 shares whenever you sell covered call. So he's getting a $300 premium. So if Google stays below 325, which is the strike, the manager gets to keep that 300 and pays it to you as a distribution yield. If Google rises above 325, we keep the premium, the $300. However, we just missed a chance of capital gain because Google exceeded that strike and we lost the shares at the end of the expiry period. So you get the idea here. You're forfeiting potential upside for income. So let's summarize the strengths of JAPQ. You have a high monthly income, often around 8-10% annually. Less volatility because, as I explained, you know already what you're getting to every month. The manager already sells his covered calls, so he already got a bunch of premium there, so he can expect what's going to happen in the next month. So it's less volatile than someone who's not using options. The option is like hedging, so it's someone who's not hedging basically versus someone who's hedging every month all the time. So the person who hedges has less volatility than the person who doesn't. The benefits from volatility, you're getting paid because of volatility. All that premium income is just volatility. It's just the price for volatility. And you're on the safe side because you're selling calls, you're not buying them. As you know, in finance, 80% of call options expire worthless. So you're not buying them, so it's good. You're not taking any risk. You're selling them. The fund is selling them, so you're taking advantage of people who are willing to take the risk of buying a call option. So no need to manage option, as I mentioned. So the fund does that for us, and you get paid that distribution yield. And if the market is doing well, you still capture some of the growth. Lower management fees is only 0.35%. This is really low, very competitive for an active option ETF. It's ideal for beginners, retirees, conservative investors, income focused, people who are seeking passive income and cash flow monthly. It's definitely one of the funds to consider. As you can see here, the performance is not bad. It's year-to-date 14.39%. On a one-year basis, it's 14.87%. So this is great. This is actually total return. So it's the return from the distribution yield plus the performance of the fund. So it's 14.87 in 1 year, plus in the 3 years, the average return was 22.30%, which is really high for a covered call ETF. You're getting the monthly income plus absolutely great performance. An average of 22.30% is definitely high. And obviously, like past performance doesn't guarantee the future, but it gives us an idea that when the market is doing well, this fund is able to capture some of the growth. They are not forfeiting the growth completely. And as I explained, because they use out of the money option. So pay attention to funds that pay a distribution yield that sounds absolutely phenomenal, like 30% or 25%. You can be just open Yahoo Finance and just look at the price performance, and you will see that it's going to be terrible because you cannot pay a distribution yield of 30% and end up with a total return that's 50%. It's just impossible. If you're having too much distribution yield, that means that the fund is super aggressive, forfeiting any growth and just going for that maximum income, especially when they're selling in the money options. So I'd rather stay with a fund that pays a reasonable distribution yield, still high, but it's reasonable, and also allows me to capture some of the growth, because at the end of the day, you're investing in tech stocks to capture some of the growth too. You're not just there for the income. So I hope this video answered your questions. And if you have any comments, please go ahead in the comment section and any questions there. Thank you.